Hey, welcome back, everybody. So now let's talk about the two types of risks that there are, right? The first one is speculative, right? That is a risk that is associated with either a gain or a potential loss in the future. And that would be gambling or investing in the stock market, right? Those are not insurable. Right? No insurance company is going to pay you or insure you if you were saying, hey, I'm going to Vegas. I want to make sure that I can backstop my losses in place and just go up there and spend all your money. They're not going to do that, right? There's limits and limitations to insurance. Most people aren't aware of that. That goes anywhere from your car insurance, your home insurance, business overhead expense, to life insurance and disability. They all have limitations, right? The high end of what a company is going to agree to insure, right? So pure risk is the other side, right? So you have speculative risk, and then you have, that's easy for me to say, and then you have pure risk, and that is the potential to experience a loss. There's not a gain. You cannot gain in pure risk. Right. So this is where insurance comes in. This is where we want to talk about transferring the risk of things. Right. You work hard, you get great things, right? Whether that's a car, a jet ski, a Jeep, whatever. Right. You collect things, whether it's stamps or something, and then you insure that. Right. You have different types of insurance in place to protect against the potential loss of those things. If your house were to burn down, if you were to have an accident, theft, all these things, right? And the potential for accidents is something called exposure, right? Risks are evaluated and given a risk and rate of exposure. That's how they come up with the premiums, right? That's how they come up with how much it's going to be out of your pocket for them to make sure that they're able to provide you with the service that you're looking for and that you want, not that what you need, what you want in the place that something were to happen, right? So that's the most important part, right? Understand what exposure is, how that dictates the rate. This dude over here, he's not paying attention at all. I hope you are. So the higher the risk, the higher the premium is basically what I want to say. If you're a low risk person, right, that means if you drive 100 miles a day, your chance of your exposure to risk is much greater than if you only drive 10 miles a week, right? So you'll get a lower rating and a lower premium because you're driving less. You have less exposure, right? Does that make sense? I hope it does. If you have any questions, shoot me a message. Throw something in the comments. I'll reach back out to you, and then happy to help any way I possibly can.